Let's talk about this 4% rule. Kelly, what is it?
Yes, it's much discussed in the financial services industry. It's kind of a rule of thumb. So it's really pretty vague when it comes to applying to somebody's specific financial plan. So I kind of use it as like a temperature gauge. But essentially, the quote unquote 4% rule came from a financial advisor back in 1994 who was looking at investment portfolios and trying to figure out how much his retired clients could pull out of that portfolio in a given year over the course of their retirement. So he looked at a 30-year time frame and not run out of money. Do you know what was happening in 1994, Greg or Pablo?
1994. Not on
The
top of my
big
head.
theme around retirement was switching from pensions to 401k.
Yeah.
So I remember that because that was, I'm dating myself, but that was the year I started working. I was in this management training program and we did this rotation in HR and we were introducing a 401k plan for the first time. And there was much discussion about it. You know, people who had been working for some time were really concerned and upset about losing their pensions. People like me were independent Gen Xers were like, this is great. We have control over things.
Right.
I think the results have been mixed. The point of that story is around that time, the responsibility for making sure your retirement funds lasted shifted from your employer to you as the individual. So that's when people like Bill Bengen started to look at how long your portfolio is going to last. What can we really take out? Because the market fluctuates year to year, right? So this happened in 1994, and based on his research, he found that 4% adjusted for inflation every year was the magic number, quote unquote. Like that's how much you could take out and not run out of money over a 30-year period. And he argued that could last theoretically up to 50 years, but that wasn't really tested. So in 1998, Trinity University out of Texas updated that, and they published a paper called Retirement Spending, Choosing a Sustainable Withdrawal Rate. So what they did, instead of looking at the maximum of what you could take out of a portfolio, not run out of money, they looked at different types of portfolios from 100% equity, AKA stock, to 100% bond, and different withdrawal rates, like 4 to 12%. Generally, what they found is the higher the equity percentage, the lower the withdrawal rate, the shorter period of time, the higher the probability of success, right? And the more you go out, when you start to stretch out the time period, the more likely you are to potentially run out of money. And the higher the equity, I think, is interesting too, because what do we know about equity portfolios? They follow the market, right? Yep. Exactly. So those are the two sort of major studies. Morningstar also, a couple of years ago, when interest rates were really low and inflation was really high, so there's much more pressure on your portfolio, right? You know, if it's not growing as fast, it has to go further. They came out and they updated their study to say, I think it was 3.3%. Yeah. So in 2021, they published a research paper saying that the 4% rule was no longer applicable, and they recommended a withdrawal rate of 3.3% to make your funds last. And then they updated that in December 2022 to 3.8. So think about this: if you're a retiree in your first year of retirement, you're sitting down with your financial advisor, and you're like, well, you know, what is my, or I'm coming up on my retirement, what can I take out in my first year? Well, according to this research, 3.3%, according to that, it can really be a little bit unnerving. So as a financial advisor myself, if I'm working with a client, I'm going to get much more specific about what are you spending today? What are your actual expenses in retirement? Let's talk about actual dollars you can pull out, what your actual portfolio is, right? So they're much more specific tools that I would use. But I think in terms of going back to the original question, what's the 4% rule? It was created to help people have a good gauge of how much money they could take out and not run out of money.
Yeah, and let's help people feel what that really means to somebody who's retiring. Let's just say that the 4% rule applied to them, which it doesn't generally, you know, it's a rule of thumb, but let's just break that down. You know, the 4% rule says that if you are lucky to have $1 million in your financial portfolio, that you're able to take out $40,000 to support your retirement lifestyle, which, I mean, Kelly, I would love to hear your insight on how many retirees actually, can support a lifestyle at $40,000 in today's cost environment. But what then it also says is, if that number's now 3.8 or 3.3, that number is now $38,000 or $33,000. So it reflects what we all know is happening. It's getting more expensive to live, right? Inflation continues to happen. It's not 9% inflation like we had a year and a half ago, but it's getting harder and harder to live. And this puzzle of figuring out how to retire comfortably is getting harder for average Americans to do. So, Kelly, talk to me about that $40,000 a year. Is that even realistic? What are you seeing with some of your clients as far as how do they look at that and make decisions on how they can support a comfortable retirement?
Yeah. So my clients tend to be, I don't work with retirees. My clients tend to be in their 30s and 40s and 50s. They're either making good money for the first time and really getting serious about saving. Maybe they're invested in their businesses. Maybe they're thinking about exiting a business, but they're all trying to figure out, what do I need to replace my income? Whether I want to flat out retire and stop working, maybe I want to take a step back, maybe I want to take a career break and do something else. So we look at it in terms of, what's your income now and how can we replace that income? And the traditional industry answer has been, your investment portfolio. And if you have, you get to $1 million, you need 40,000 or 30,000, depending on the research. So with my clients, what I do is use that as kind of a target. Like if we're just starting and really trying to educate someone about how much they're going to need to save and what they're going to what they're going to think about in terms of actual replacement, I think it helps people get really serious about how much money they need. And then we also always start with cash flow. What are you spending today? And you'd be surprised, like a lot of us don't really know where our money goes, So understanding what you're actually spending on living expenses, on housing expenses, how those are going to increase over time, what your additional costs might be in retirement, maybe like healthcare costs, or, if you're changing your primary residence, going into the assisted living facility, those types of things, like we can sort of project those costs, or maybe you just want to travel a lot. So your costs may go up. So figuring out what you're making today, your income is today, and your cash flow needs, and what your cash flow needs are in the future, and then trying to create a target of how we're going to replace that income. And there are lots of ways we could do that, right? The traditional way, you could do rental real estate where you have a good idea of what your rental incomes are going to be. There are lots of other products. I'm product agnostic, when it comes to where you invest and how you invest. Some are easier, more accessible, but we're always going to look at the implications for you personally.
Got it. Kelly, we've done a couple of shows recently on, you're kind of talking about this idea of when you're there, what is that baseline that you can really count on? I didn't know that this was something that started in 94, right? Like 94, I'm like a freshman in high school. And by the time I graduated college, 401k was just a thing that everybody did.
Yeah.
Right.
Yeah.
And I wonder, I assume that it's not the case for people that work with you because they're serious about getting to retirement. But I wonder in the industry that you're in, right? Like, is there talk about how well it's working out for American people of taking retirement into their own hands? Like, is there anybody that's out there kind of like beating the drum of, okay, in 1994, we thought we could switch to this. It's time to switch to something else, or time to like rethink this thing based on results? Because the headlines that we've kind of been diving into lately have basically told us that something like 36% of millennials think that they're going to reach retirement or like won't reach retirement comfortably. And that's the generation that sees it the best. But from your perspective and your industry's perspective, what is the chatter on this decision of switching from pensions to like now putting it in your own hands, and like the level of urgency around having to rethink that?
Yeah, I don't know that it's being led by the financial services industry necessarily. I think the financial services industry answered with different types of products, 401k, paycheck replacement type ideas, annuities, different types of products that would sort of replace that predictability of a pension. I think that was the initial answer. What I see now seems to be more around social policy, where I think there are questions around, has that worked? I read something recently about some of the major companies are starting to introduce pensions again for the first time. And they may not be pensions of old, where they're completely replacing your income, but there's a baseline level of pension. And then there's 401k on top of that. And so what I see is more of a social, question, and I think a policy question. And then I see bigger companies starting to address that in terms of benefits for their employees and employee wellness so that they can attract employees.
It raises some interesting questions because if you think back to the late 80s, early 90s, pensions were ubiquitous and Social Security was funded. I don't know what they looked at in 1994, if they thought it was going to be funded for forever or whatever, but I can tell you that today it's a lot less stable than what it was then. So, you no longer have pensions, right? For most companies, people's retirement accounts are in their own hands, which for some is a really great advantage. For some who are part of our community and who are not your average investors, that's can be an advantage. You can certainly gain because of that, but there's a huge population that it is hurt because it's not done for them like it was. And then you compound the fact that Social Security, none of us believe that it's going to be there when retirement age is upon us because it's not funded. You take those two components away, you start to think about the social implications of that. And, you can paint a pretty concerning picture for the state of our country.
And as a amateur behavioral economist, right? Like you look at this change in what's required and what we're able to do. And to Kelly's point, I think the financial services responded how they should. Hey, let's make some products for this so that if you're on top of this, that's what's gonna, we can facilitate it. But I think there's a whole question, beyond all of that, which isn't just like what products are available, but what is the decision-making architecture that gets you to being able to use these products, right? Like, we're very familiar with 401ks and that, there's data behind this idea that if the company defaults you into a 401k versus electing into a 401k, you're going to be better off for retirement, overall. And then now that means that, okay, so now people are going to be planning their retirement around specific products and specific like levers that get you into that already. And where does that leave real estate, right? Like, I think that makes it interesting on the problem that JWB solves for, which is right now you figured out how to allow folks that don't want to be real estate investors to invest in real estate as passively as possible. But in order to really make all the assets that are now on the table available for all, there is, the decision-making architecture and the ease of use and who gets to opt into this stuff and how easily starts to really guide how you can retire, I guess. Does that make sense, Kelly? Like, it's how you can retire that it starts to guide that stuff?
Yeah, I think that's always been a little bit of a question. I mean, but if you had a pension, it was sort of solved for you. Now, like I told you, I'm an independent Gen Xer. I don't like to be controlled by companies. So when I started, I was like, it's fine with me. And I love the 401k. And also, like, I can take it with me. If I leave this company, I'm not obligated to work here for 30 years just to get my pension. So I think it's just gotten more complex, frankly. I think if you were happy with that path and it was available to you, plenty of people were comfortable with that. Plenty of people would be independent, built their own companies, changed companies, had to come up with their own retirement plan to begin with. So I don't know, that's really changed. It's just that these sort of rails, if you will, aren't there the way that they used to be. You
Right.
used to have a train track and now your plane can go any direction.
Mhm.
You can fly at different altitudes, you can fly at different speeds. So I think it's just gotten a lot more complex. And we're talking earlier, it's not just the products. I think that's part of how financial planning as a practice was born, right? Because I'm not selling a specific product anymore. Now I'm looking holistically about where you're trying to go. And maybe it's not a linear path. Maybe you're not going to work for 30 years and then quit together and totally go hang out on the beach. Maybe maybe you're going to work for 15, you're going to build up some assets and then you're going to change careers, or you're going to take a break, or life can happen, or lots of different things. So I think it's much more about sort of your values as an individual as an investor, who you have to take care of yourself, for your family, what you're planning for, using everything that's available to you and getting all of your levers sort of pointed in the right direction so that you have as many options available, and yes, we can come up with like a specific number as a starting point, and a conservative number that if you get there, you can feel pretty confident you have options. But I think the whole plan picture has gotten more complex, which makes our discipline like even more important.
That makes a lot of sense.